The auditing students are really stressed because there are no videos for them to watch because I haven't been teaching that class. You know what the intermediate students did, right? They watched the videos. And then these high maintenance kids sent me emails about questions about this, and this, and this, and this. Right? I don't understand. Can you help me? Leave me alone, right? I've got a day off. No, I answer videos. Right? Okay. Even though my computer broke. You know how much fun it is? You guys do know, right? Typing into this thing. Luckily, I've got a little Kindle thing, so it's got a little bigger keys. But anyway, all right. So let's do this thing. Let's see what we can do. All right. What is a synonym for left? Synonym for right. The points you did get on the test. Okay, anyway. There are 5, and why are they named that? Because they are, right? Just cuts, right? You know that, okay? Can't figure it out. That's just what they are. Okay, and then there are 5 kinds of accounts. 3 on the balance sheet. Come on, guys. All right. 2 on the income statement. Okay, and this should just be automatic to you by now. You've been working it is. Okay, assets are on the left, and debit means left, so therefore they increase with. Assets are increased with. Reduced with. Why? Because they're on the left. That's it, right? You got it. You don't have to remember that. Common sense, huh? Because left and debit mean the same thing, and assets are on the left. Okay? Know that, right? And you know, if you didn't do very well in this quiz, you kind of, I do know that. Well, can you convert it to using it a little bit? Okay? That's the next piece. Okay? The liabilities and equity are both on the right, so therefore they are. Increased with credits, reduced with, and that'll give them a normal credit balance. Okay. What are revenues? Why? No, they're not already. They're a subset of equity. Yeah. Okay, they're a separate statement. Okay, subset of equity. Equity is what? Increased with a credit because it's on the right, and therefore revenues have to be credit because they're increasing equity, right? How would you reduce it if you put too much in? Debit. Okay, expenses have to be what? Debits. Why? They have to be the opposite of revenues. That's true. And what else? They decrease equity, and as you increase those expenses, you are reducing your equity, right? Everybody's got this model. You see it. Don't stop using it, right? Some of you used it on the quiz, some of you didn't. Ah, that's a big difference. Okay, and as we go forward, we use this over and over and over and over. One of the reasons I became an accountant is because it's really easy and it pays well. And I mean it's easy. If you understand this model, you got it made. If you don't understand this model and you don't figure this model out, you will take this class again, or you will just change your major to something else, where you don't have to do this class. I'm not kidding. I've actually had evaluations over the 30-some years I've been teaching. A couple of times, kids said that it was a pretty good class considering it was rote memorization, and you just memorize everything. And then it used to be to write down what their grade is. We don't do that anymore. Their expected grade. It'd always be to B or an F. They tried to memorize it. How many assets are there in the world? Billions. You're going to memorize them? How to increase and decrease them? Or you just want to know that assets are increased with a what? Debit. And assets are all my possessions. Huh? Reduced with a credit, because it's got to be the opposite. Big deal. How many people you owe money to? Liabilities. Oh my gosh. How many companies? How many people? Billions. Come on. What's the deal? Anything I owe is a liability. It's increased with a credit, reduced with a debit. So all you have to do is understand what the business transaction was, which sometimes is really tough. Right? GE, they're trying to buy them out again, right? Another company's trying to buy them. Right? GE Appliances, not all of GE, of course, but the biggest companies in the world. Okay, but anyway, their appliance division here, they're trying to buy it out. Imagine the journal entry. How many things are going to be exchanged? I don't have to do that one. Okay. Got it? But you can, right? It's all assets, liabilities, equity, revenue, expenses. That's all there is. Okay? Everything fits. All right. So think of the 3 distinct time periods then that you could pay for something when you buy it, right? 3 distinct time periods. Or, well, let's do it. If I'm buying something, one's before, I can pay in advance before. At the same time, okay, and after. Would you read this stuff? Yeah. Did you listen to the video too?
No.
It's even easier to listen to the video, huh? Because they say exactly the same thing, sort of in different ways every time. Okay, but that's good. You read it. You paid attention. right? She's got it. That's right. Those are the 3 times, huh? How about it? That's if I buy something, right? Buy services. I could pay at the same time. I could pay in advance or I could pay later. That's all the possibilities, and I am going to pay for it unless I go bankrupt or something, right? I am going to pay for it. That's my intention. So I'm either going to pay for it at the same time, in advance, or later. That's it. Okay? How about if I sell something? When's my customer going to pay me? At the same time? Before? Yeah. Before, during, after? Yeah. Okay? Before, at the same time, or after. That's the only possibilities that they're going to pay me. By the way, we'll learn how to account for if they're not going to pay me, or my guess that some people aren't going to pay me real soon. Okay? So we'll do that to allowance for doubtful accounts, bad debts, okay? Because some people don't pay me. Right? All right. So fine. When you sell an account, that can happen to you. All right. So here we go. Let's do these. Give me some sort of a business, a service business. Let's do a service so we don't have any cost of goods sold, no inventory, no cost of goods sold. We'll do that later. Some sort of a service business I might be in where I sell services. Plumbing. Let's do landscaping. The problem is, well, plumbing would work too because we bill it by the hour, but we also have lots of materials that we bill. And actually, landscaping we do too. So, yeah, the service aspect of it though, plumbing or landscaping, babysitting. Yeah, there's very little materials there, diapers, right? There's very little materials there, supplies. What's that?
People that give back massages in the mall.
Yeah, there you go. People that give the back massage in the mall. Yeah, okay, yeah, services. Okay, all right. When I used to teach executive MBA, they'd always come up with prostitution. You know, when you massage them, they're not prostitutes. No, but yeah, they'd always, and then they'd say, well, it's the oldest industry in the world. And, yeah, maybe. Okay, so, all right. They're old people, executive MBAs. They don't have lives, so they have to do things like that. Okay, anyway, because they're old, right? All right, so let's do I like massage. That'll be fine. Massage company. You like it? I bet there's nobody named that. Okay, anyway, massage company. Why do we give people massages? I hope we like doing that, right? Otherwise, spending your life doing something you don't like. I hope you like doing it. But why do you do it? So they'll give us their cash. That's true, right? And that's how we make money, increase our wealth. That's how we earn what, guys? We earn the cash. They give us the cash at least, but what do we earn? What's the representation of the increase in our wealth called? Those 5 accounts, what is it? Asset, liability, equity, revenue, expense. What's it going to be? Revenue. It's going to be massage revenue, maybe. Massage service revenue. Got the idea? Okay, good. All right. Who might buy massages? A company that might buy massages.
Sports teams.
There we go. Sports team. Bellarmine might. Bellarmine does it during finals. Pays somebody to do massages and gives them to the kids. And why do we do that to you guys? Why do we do that? Because you guys are stressed. Yeah, but why would Bellarmine do it? To hope that you do better, which will enhance their. So we can make Bellarmine better, which will enhance our revenues. If we were a for-profit business, but it does enhance our revenues. If you don't flunk out, we get more tuition from you. How about that? It's true, right? If you do flunk out, we don't get any future tuition from you. We don't even flunk out. Well, that's true, but you know what? Hopefully they collect more revenue from you than I cost, and everything else here costs. Sort of, right? But yeah, we try to do that. Although we don't really accomplish that. We have to have a lot donated, so it's not a very good example. But if I were, let's be Papa John's, okay? Papa John's is bringing people in, just like Bellarmine does. Only Papa John's actually makes money, okay? So their revenues exceed their expenses by a long ways. Okay, Papa John's does real well. So Papa John's is the customer, got it? What's it going to be for them? They're making their employees happier by having their next massage. What's the deal? It's going to increase productivity, which is going to generate more what? Revenues. You got it. So this is one of the costs of getting revenues. So what do we call all the costs of getting revenues? Expenses. That's what they are, right? If you realize that, you got it made. Okay, so let's do cash now in both cases. Okay? Start with that. This one we've already done. This one's easy. Okay? Cash now. Okay, so let's say that the massages were all done in the month of February. Let's use a February. Okay, it's 2/28. On 2/28, the massage company gives a bill to Papa John's, and Papa John's pays it on the same day. Businesses don't usually do this. If you were doing business with Papa John's, you probably couldn't walk in and hand them a bill or have them hand you cash. Not gonna happen. Okay. Although when they sell you pizza, they want your cash, don't they? Yeah. So anyway, they give you the pizza. That's because they don't trust you to pay them later. After you eat the pizza, are you real anxious to pay for it? Their pizza's good if you like greasy pizza, especially if you pour that poisonous oil on top of it, right? They put a little thing of oil, right? Ever tasted that stuff? It really tastes good, doesn't it? That's because it's about 180% fat, right? Anyway, yeah. So it's like a shot of cholesterol. Yeah. Anyway, it's great. So I used to get it from my kids all the time. Yeah. I don't eat their pizza anymore, even though I think Papa John's is a great company. There's actually good pizza in the world. Yeah. So anyway, it costs 3 times as much though. So anyway, all right. What's that? A whole lot better. Yeah. 2 or 3 times more if you have the 3 times a night. Keep working, guys. Okay. Anyway, so we did the massages. So why do we do the massages? Yeah. So we can. That's how we earn our revenues. Huh? So what are we going to call this? Let's say it's $1,000 worth of massages in a month. Massage revenue. How do you increase revenues all? Credit. That's increasing equity, right? So we're going to call this massage revenue. Like it? Massage service revenue. And what do you want to debit? What do they give us? Cash. Cash is a what? Asset. Why are you debiting it? Because you have more. Now, here's the thing. Separate those two things. One thing happened, I earned the revenue. Another thing happened, they gave me cash. Can I earn the revenue and them not give me cash? Of course. They could pay me later, and they could pay me in advance. Got it? They could give me a piece of equipment instead, right? They could give me a copy machine, I guess. It's worth $1,000. I could debit copy machine and credit massage revenue. Got it? They just happened to give me cash. Okay? That's it. And that transaction's done, isn't it? It's over. Okay? Let's do Papa John's. What would they have? I bet you if I got cash, they gave up cash. Right? Massage company got the cash. Papa John's probably gave it up. So what would they do? Oh, she wants to do massage expense first. I'm good with that. Or whatever they want to call it. Employee feeling better expense. No, I wouldn't do that. Probably massage expense, huh? Okay. So why am I debiting it? Because it's an expense and I have more. And how do you increase expenses? With debits. And what does that do to your net income? It reduces it, which does what to retained earnings, which is one of your equity accounts. Reduces it. You should be thinking this way by now. If you're not, oh man, you're in trouble. By the way, I do realize that most of the people who are on the lower end of the scale didn't show up today. Right? So they've already quit. Oh, one other thing I should tell you is I don't care what the GPA is in this class by the time we're done. I've had as high as GPAs close to 3.0, right around 3.0. And I've had its lowest, did I tell you this? 1.4. Wherever it is, it is. I've had thousands of students in this class. Okay? So wherever you guys come out, fine. The GPA tends to go up when people drop. Funny, huh? All the D's and F's drop, it goes up. But the test and quiz are going to get harder. So, right now we have 10 A's, was it? Something like that. We'll have 4 or 5. And then we'll have 3 or 4 or 5 A minuses. So, we'll get a decent GPA. Yeah, C plus or above in this class is a really good grade. Really good grade. You know a lot when you're done. But get as good as you can, right? Okay, so it's debit massage expense. What do you want to credit? Cash. Why do you want to credit cash? Because you have less. That's all there is to it. There's just nothing to this, guys. Nothing to it. Okay, so let's do cash in advance, huh? Yeah, this is just if it happens. They're separate scenarios. One's cash now, one's cash in advance, another one's going to be cash later. Okay. Makes sense? By the way, if you can do these 6 things we're going to do, cash now for revenues and expenses, cash, excuse me, cash in advance for revenues and expenses, and cash later for revenues and expenses, you know how to do everything. There's no other possibilities, right? That's it. That's all that happens. Okay? And we got And then we've only got 6 different times, right? 3 for revenue, 3 for expense. And we got everything, you guys, everything for the entire course. You got to make, okay? You can have this really solid. After the first test, it just everything just kind of falls in place after that. Business gets complex, but accounting doesn't, okay? All right. So here we go. Cash in advance. Let's say January 30th. Papa John pays for, right, the massages, and the massage company gets the cash, right, receives it, okay? So what happens? Papa John's has what? Less cash. So what would you want to do with Papa John's? The cash. If they have less cash, what would you want to do? Credit, of course. When I give up cash, I credit cash, don't I? It's an asset. I have less. So I credit cash. Absolutely. Okay. By the way, what do you think massage company would do? They got the cash. Debit cash. You know, they got cash. Debit it. No kidding.
So what did you call that?
Oh, all right. Let's go there. Does massage company have revenue yet? No, they haven't done massages. What do they have? Revenue. They have the cash. And but then what else do they have? They promised to do what? Massages. And it's going to be revenue after they do the massages. So guess what we call it now? Revenue we haven't earned yet is called unearned revenue. You like that? Because that's what it is. What kind of account is unearned revenue? Asset, liability, equity, revenue, expense. You owe them massages. What do you think it is? It's a liability. We got it, don't we? And how do you increase liabilities? All of them. With a credit. So you debit cash for 1,000, and what would you credit? Unearned massage revenue. You like that? What kind of an account is that again, everybody? That's a liability. You have to know that's a liability, right? Makes sense it's a liability? You owe them the work, right? You're not going to give them their cash back. That's not your plan. You're going to earn the revenue, aren't you? Everybody agree? So you can satisfy liabilities by doing work. Okay? No problem. All right, good. Well, what would Papa John's have? If massage company has that unearned revenue, what would Papa John's have? Yeah, they prepaid the expense, didn't they? They have an asset. They get to have $1,000 worth of massages done for them without paying for them again, right? It's a real asset. Everybody agree? So what would be debit? Prepaid. Now, what kind of an account is a prepaid going to be, do you think? It's an asset. It's not an expense yet. We call it prepaid expenses. Just like unearned revenues, right, or a liability. Prepaid expenses are an asset. What would we call this probably? How about prepaid massages? You like that? That would be a debit of 1,000. Everybody good? This is easy, isn't it? Okay? Don't try to remember. Let yourself figure it out, and you got it made. Okay? All right. How many times have I said that already? Huh? Over and over and over. Huh? Don't try to remember anything. What for? To waste your memory. So then what would happen, by the way? They paid us in January. What are we doing in February? How does this business transaction work? You know, they paid me for work I'm going to do in February, in January, so I have unearned revenue. Papa John's case, right? They paid for it, so they have prepaid because they haven't used it up yet. Well, what happens in February? A whole bunch of massages, I guess. Whatever you get for 1,000, huh? So what happens to the massage company because they delivered the massages? Yeah. And what do you mean by transfers? I satisfied the liability, right? I don't have the liability anymore if I did the massages, and what do I have now? Seeing as I did the massages. The revenue, I earned it. Yeah, we're there. So how would you get rid of that liability? What do you want to do? Debit it. How do you get rid of every liability, everybody? Debit it. So that unearned massage revenue, it's debited. And what gets credited? Revenue. What do we call it? Massage revenue? What do we credit when we earned it, when they paid us at the same time? We credit massage revenue. What are we going to credit when we earn it, when they paid us in advance? But when we earn it, what are we going to credit? Massage revenue. Why are we crediting massage revenue? Because we earned it. Oh. What are you going to do over on the other side? What would Papa John's do? What do they have? They have an expense. Up here they had massage expense. Why? Because they used up the massages. As soon as somebody massages somebody's neck, it's used up. It's gone, right? You don't get to keep it. It's not an asset you keep, right? Okay, so what do you want to do with this thing? I used it up. Want to debit the expense? We debited the expense up here, didn't we? When we used it up, what are we going to do here? Debit the expense. Of course we are. So it's exactly the same entry, isn't it? And credit what? I'm not going to pay him again. It's not going to be cash. I'm not going to pay him later either. I already paid him. So what is it? I used up that prepaid. Absolutely. And if you used up an asset and turned it into an expense, what do you do to the asset? You debit the expense. What do you do to the asset? You don't have it anymore. What do you want to do to assets when you don't have them anymore? Credit them to reduce them. Yeah. And what's the name of the asset? Prepaid massage. Yeah. That's it, guys. That's simple. Okay? All right. What's the other possibility we could have? Cash later, paid later. Do that. All right, Dave. So now in February, the massages are done, huh? And it's not going to get paid until maybe March. So let's say it's going to get paid March 1st, okay? That's fine. Okay, what happens when the massages are done? What has the massage company because they did the massages? What do they have because they did the massages? They have revenue. They had revenue here when they did the massage. They had revenue here when they did the massage. Guess what they're going to have when they do the massage if they're going to get paid later? They did the massage, they got the revenue, right? Assuming they're going to get paid. And we'll get into that later, okay? Judgment you have to make about that. So I'm going to credit massage revenue, aren't you guys? And what are you going to debit seeing as they didn't give me cash? What did they give me? They're promised to pay me later. They have an account payable. What do we have? I have an account receivable. A note if they sign a piece of paper, right? Promising to pay me later and interest and stuff. But what if I just trust them? An open account. Account, right? Account receivable in this case. I have the receivable. What are they? That's an asset, right? What do they have? A liability named accounts payable. That's it, guys. Okay, so we're going to debit. Why am I debiting accounts receivable? It's an asset, and I have more. How do you increase all your assets? With debits, of course, right? Okay, what would happen on the other side? Papa John's used up the massages, right? What did we do when they used up the massages before? We had massage expense, didn't we? We had massage expense, didn't we? What are we going to have now when they use it up? Massage expense, because you used it up. That's it, okay? Massage expense. Kind of like a little puzzle, and once you see it, it's kind of, wow, there's nothing to this. I'm not going to credit cash. Why not? I didn't pay it. I'm not going to credit prepaid. Why not? I didn't pay for it in advance. What am I going to credit? I owe it to them. Accounts payable. You got it. Accounts payable is a what? Liability, and you have more. That's it. Okay? Very good. All right, gang. Now it's March 1st. What happens March 1st? So you have to know what happens. Just read carefully and let yourself think about it, right? When you look at problems, okay? And in real life, ask, right? Listen carefully, try to figure out what happened. A lot of times people won't know what happened. So it's kind of challenging. What did you do? What do you mean, what did I do? I don't know how to record it. I know, I need to know what you did so I can tell you how to record it. And then once they tell you what they did, it's nothing to it, right? And they think you're brilliant. It's really cool. Pay you a whole bunch of money. You're brilliant, you know. But you know left from right. It's pretty cool. Okay. Don't you guys ever tell anybody how easy this is after you realize how easy it is. Kind of like a cartel, right? They keep them in the dark. You know how to do something really simple and charge them a fortune for doing it. That's what computer people do too. It's probably little gremlins running around down in that thing. We just don't know it, you know. They know how to talk to them and we don't, right? That's it. Okay, anyway. So, I know it's just positive and negative charges. That's all it is. That's all a computer is. Okay, great. That helps a lot. By the way, I don't think computers are all that remarkable compared to the fact that when you hit that switch over there, light comes up here. Actually, compared to the fact that the sun comes up every day, it's kind of remarkable. Yeah. Everybody thinks modern technology is the only thing that we ever discovered that was meaningful. How about fire? How would you like to live without heat, without light? Yeah. I think there were major advances prior to computers. What do you guys think? And then we think the internet is more important than computers were as they developed. The phone in your pocket, which is just a computer anymore. It's just a small one. I don't think it's all that remarkable. It's advanced technology. For now, advanced. There was somebody on TV the other day who was pretty good. And he was making a little bit of fun of older technology. And he says, imagine what they're going to say about us in 100 years. How primitive we were. Right? Because, okay, anyway, so they'll probably still be doing left and right. I don't know why. Okay, anyway, so neither do you. What do we do on March 1st? Actually, we have computers do. What happens? Oh, you don't have the massage revenue anymore now because the new month starts? You don't believe that? I think I earned the massage revenue. That didn't work. I think they still have the massage expense. It was just in February. What happens in March? Oh, we get paid if we're a massage company, right? And if we're Papa John's, we pay for it. So let's do the easy part first. What happens to a massage company? They debit cash. Why? Because they got cash. What happens to Papa John's? They credit cash. Why? Because they got rid of the cash. They gave up the cash. Okay, now we got to do the other side. So you can do half the entry, huh? Well, they gave us the cash, so it's not going to be massage revenue again, right? You're not going to get rid of massage revenue, but you're also not going to record more. What is it? Oh, you don't have this account receivable anymore because they paid you. Got the idea, guys? That's absolutely correct. Okay? I don't have the receivable anymore, do I? Okay. What would happen over for Papa John's? Yeah, they don't owe this account payable anymore. How do you get rid of liabilities? You debit. And that's what you want to do, of course, reduce the liability. That's it, gang. Okay, we're done. All right, now let's do something else with this. Okay. All right. Oh, let's get rid of that. Okay, let's take these transactions then, and let's look at what happens to the balance sheet and the income statement. Assets equal liabilities plus equity, revenues, expenses. Net income. Okay, so here we go. Tell me what happens in the cash now. Let's do massage companies first, okay? What happens? They debit cash, and they credit massage revenue. So what happened in the financial statements in February? You have to know this or you couldn't have done the entry, huh? Right? So what happened? Cash, which is an asset, went up by 100, and credit massage revenue. Revenue, oh, it's 1,000, I'm sorry. Assets went up by 1,000, and revenues went up by 1,000, right? Debit and asset, credit revenue, that happened. And then what did that cause to happen? Equity went up by 1,000. How do we know that? Because net income went up by 1,000, and net income gets added to what, everybody? Equity, retained earnings, right? Yeah, equity. It's true, isn't it? That's all there's to it, okay? Well then, let's do the second case there, okay? What happened? This is where I got paid in advance. Okay, what happens, guys? We debit cash and credit unearned revenue, right? Everybody see it? That's what it was, wasn't it? More cash by 1,000. And more. So more assets, not more revenue. More liability, unearned revenue. What happened to equity? Nothing. We didn't earn anything. We didn't have any expenses. Everybody agree? Okay, so that's what we have on our balance sheet at the end of January, right? More cash, more liability. Then what happens in February, you guys? What's the next one? We reduce the unearned revenue, right? Because we earned it. The unearned revenue's gone between the 2 months, isn't it? You know, they paid us in advance and then we earned it. It's gone. Okay? And what do we have? We credited revenue. We have more revenue by 1,000, don't we? Which means we have more net income by 1,000, huh? Which means we have now more equity by 1,000. Yeah. And you know what? The end result's exactly the same. I have more assets here, more equity here same thing over here. It's just that it's spread over 2 months. As we get to January, do you want to show revenue you haven't earned yet on your income statement? Of course not. You'd be lying. So you wait until February. Got it? Do you want to show the cash in your balance sheet and the liability in your balance sheet? Sure, because you have the cash and the liability. You're just telling the truth. That's all it is. Are you finally getting this? Pick it up. Redo the class. Years later. You didn't even get a perfect quiz, did you?
No, you put the contributed capital in there.
I think it's funny. Yeah. See you well in intermediate, now she can't do principles. It's pretty sad. Okay, anyway. All right. You are learning a lot, though, by doing this again, aren't you? Isn't it amazing? Kind of cool, isn't it?
It actually helps in the other classes.
Uh-huh. Yeah. That's because I'm brilliant. Yeah, right. Nothing to do with me. Hard work. Revenues, expenses. I never take credit for anything my students accomplish. But if you want to send me 10% of your paycheck for the rest of your life, I'd be happy. Retire now. Yeah. Thousands of people. They could all send me 1% of their paycheck. I'd like it. Nobody's ever sent me anything. Little thank you notes. Big deal. Send me money, right? No. I have some students buy me dinner before, though, because that's money. All right, let's do the last one. Cash later. How's that going to work? Debit accounts receivable is more asset, right? Credit revenue, right? More revenue. We've already got it, don't we? Which is going to be more net income, which gives me more what, guys? Equity, of course. This is how we think, huh? All right. Well, how is that any different than the first one up there? I have a receivable instead of cash. If you're looking at a financial statement, do you care if somebody has cash or accounts receivable? I don't know about you, but I can spend cash. I can't spend accounts receivable. We care, right? Just tell them the truth. What's going on in the company? All right, but then what happens with this second entry down here? Now we have the cash, don't we? But what don't we have? We don't have the accounts receivable. Big deal. That's gone. What's left? Exactly the same thing as we had in the other two. Got it? It's just we want to put it in the appropriate period. That's all. And we do exactly the same thing with the expenses, huh? Let's do it real quick. It's just not a big deal. I'm on that page. Now if I add one, yeah, there we go. That was pretty good. Let's do the expenses. Here we go, guys. Can you think your way through these? We'll do all three of them. Go ahead and write down for yourself that first one. That's this transaction right here. Do that.
Testing.
They're going to have speaker in a few minutes. They're going to open those doors and kick us out of here.
Yeah, there's a class there until 11:50. So.
Would you go to that back door and tell me to go ahead and open it? Feel free to open it. Okay. Do the second one here, you guys, right? Do the first one, right? Do the second one. Can you write them down real quick? This is just the expense side, but it's the same stuff. You're just putting in two different periods, right? With these revenues and accruals. Can you do them all? This is the third one. What's the first one going to be? Debit expense, right? Increasing expenses. And credit asset. Reducing assets. Everybody agree with that? Increasing expense to do what to net income? Decrease it. What does that do to your retained earnings, your equity? Decrease it. Ta-da! Good, huh? Okay, what does the second one do? Debit, prepaid, credit, cash. What happened to liabilities, equity, revenue, expense, net income? Nothing. You just debit, prepaid, and credit cash, right? Exchanged assets. Then what happens? Increase the expense and reduce that prepaid. Not yet. It's going to reduce equity, yes. Because as I increase the expense, that reduces my net income, which reduces equity. And do we have exactly the same thing here as we have here? Yes, but we get it in the right month, don't we? Everybody got the idea? And then what do we do on the last one? Debit expense, right? And credit a liability. Increase the expense, increase the liability. So it's different, right? Increasing that expense is gonna do what to your net income? Lower it, which does what to equity? Lowers it. Are we still in balance? Assets did not change, liabilities up by exactly the same amount, equities down, yeah, everything's cool. Just make sure your debits equal your credits, it's always in balance. Might be wrong, but you're in balance, right, at least. Okay. All right, and then what happens here? You no longer have the liability, it's gone, huh? And you no longer have the asset, cash. And look at that. Exactly the same on all three of them. Pretty cool, huh? So go away and work hard.
If your liabilities go up, because
The unearned revenue, yes, that's a liability. More liability, then you satisfy the liability by doing the assignments. Yes, absolutely. You got it. Pound through these, you guys. Do a bunch of examples. It's really going to pay work now.